The wealthiest and most influential generation in history is getting old, retiring, and well, also dying. And that's changing our economy in pretty fundamental ways. Even despite their declining numbers, baby boomers still hold over half the wealth in America, with a similar breakdown across the developed world. But despite this wealth, the majority of this group are not financially self-sufficient, and now the numbers are putting significant strain on retirement systems that were never really designed to deal with dependency ratios this lopsided. Understanding the disconnect between a generational change we knew was coming and the systems that we developed to deal with it is also essential for understanding one other piece of disappointing news. Trillions of dollars in wealth are about to be handed down to younger generations that have historically been behind their parents on life's major financial milestones. As grim as it may be, for many people, an inheritance is largely seen as their greatest opportunity to catch up and potentially afford a comfortable retirement of their own. But unfortunately, for the vast majority of people, this great wealth transfer is probably only going to make things worse.
64% of Americans surveyed are more worried about running out of money in retirement than they are about dying.
And the problem is that Americans in the 1800s, about 80% of us owned a business. We were a nation of owners. Today, 6 to 10% of us own a business.
Are now paying more than $300 extra each month, on average, for the same things they were buying a year ago.
The American workforce bustles with an estimated 38 million people aged 55 and older.
My daughter needs about $20,000 a year for college. Like, where's that going to come from? I'm not going to let this girl graduate with $80,000 worth of debt. That's insane. So I am looking for full-time work.
Whenever financial markets have a little whoopsie-daisy and require government intervention to prevent further losses, there is one line that is repeated more than any other. We can't let the consequences of our own actions go too far, because the retirement of millions of regular people are directly dependent on the performance of these financial assets. And well, they kind of have a point. Since the year 2000, the number of people actively contributing to investment-based retirement accounts has more than doubled over the same time in which defined benefit schemes have more than halved. At the end of last year, here in America alone, we collectively had almost $50 trillion worth of assets tucked away into retirement accounts, with all but $13 trillion of that being directly tied to the performance of financial markets. That is only slightly less than the collective value of our entire residential real estate market, and voters are equally defensive of it. People don't want their homes to lose value, and likewise, they want to make sure that at the end of their careers, they will have something to retire on. But this logical self-interest has created some perverse incentives for the entire financial industry by making hopeful retirees the ultimate bag holders for when things start to go wrong. Whether it's private credit, private equity, BDCs, mortgage-backed securities, or residential REITs, if there is an asset that is starting to go bad, then this practically unlimited pool of cash has become a great escape mechanism to bail out flailing sectors because they know that if anything goes wrong, the government will be there to bail them out in turn. This has created a weird scenario where retirement savings must simultaneously be protected at all costs while also taking on morally hazardous amounts of risk. It's not great, but at the very least, it has empowered people to take charge of their own financial destiny, right? Well, we will get to that. After that, we also need to address some good news, which is that America is far from the worst offender in this whole game. So one of the most difficult parts about addressing this issue is that it's very hard to criticize the system of retirement savings we have without sounding like we are criticizing the idea of saving for retirement at all. As an individual, if you have the spare money at the end of the month, you absolutely should be saving and investing that excess to fund financial objectives, with what is hopefully a nice long comfortable retirement being towards the top of that priority list. What's more is that as an individual, if you can take advantage of tax-advantaged or employer-supported accounts like a 401k, IRA, or your home country's equivalent to make those savings and investments go further, you absolutely should do it. In the interest of transparency, I personally try to max out my allowable contributions when I can, partially because it's good financial discipline, and partially because Mr. Bagel would descend from Canada to slap me over the head if I didn't. But doing a sensible thing inside a broken system does not make the system itself sensible. Over the last 4 decades in particular, saving for retirement has changed a lot more than most people realize. For most of the post-war period, retirement in America was built on 3 things: Social Security, a company pension, and whatever personal savings you had managed to set aside on top of them. For most people, any combination of the first 2 felt very secure, normally with the third as a nice little bonus. Your employer legally had to stand behind that pension, and Social Security had just survived a world war. Almost none of that is true anymore. In 1980, around 60% of private sector workers with any retirement plan were in a defined benefit pension. Today, fewer than 15% are, and most of those are made up of senior employees at very traditional companies that have literally been grandfathered in, or specific government employees. Almost all of them have been replaced with the 401k, a tax-advantaged investment account offered through your job. You contribute a slice of your paycheck before tax, your employer sometimes kicks in a bit as a perk, and the whole lot sits in a menu of mutual funds until you retire. For the sake of technical correctness and completeness, the equivalent for nonprofit and educational workers is a 403b. For state and local government workers, it's a 457b. For federal employees, it's the Thrift Savings Plan, but functionally, they're all more or less the same thing. For anybody whose job doesn't offer any of the above, the backstop product is the IRA. Basically, a 401k without the employer attached. All of these share one extremely important feature. They are defined contribution plans. They define what you put in. They do not define what comes out the other end. What comes out the other end is whatever the market decides to hand you on the day you need it. For better or worse, that is a very different deal from the old defined benefit pension, where your employer was legally obligated to pay you a fixed amount for the rest of your life regardless of what markets did. And well, that shift from the employer owes you to you own a pile of stocks and cross your fingers was not an accident. The 401k started life as a weird little clause in the 1978 tax code meant to give high-ranking senior corporate executives a tax break on deferred compensation. It got turned into a mass-market retirement product in the early 1980s because it was cheaper for companies to offer, moved all of the investment risk onto the worker, and could be sold as empowerment. And it worked. According to data from the Investment Company Institute and the Federal Reserve, American retirement accounts held $49.1 trillion at the end of 2025, broken up between these various accounts. Now, beyond just simply being an enormous pile of money for the financial industry to play around with, this growing asset class has exactly the right combination of financial characteristics to make it a tax-advantaged, complacent bag holder that has ironically probably made retirement more difficult for average people for 4 distinct reasons. So it's time to learn how money works to find out who actually benefits when politicians line up to protect people's retirement. And, spoiler alert, why it isn't you. This video is sponsored by Relay. When I started running a business, I did what most people do. Everything went into one account, and figuring out how much was actually available after taxes, payroll, and expenses meant scrolling through transactions and doing mental math. It was a mess. Relay is a business banking platform that fixes this by letting you open up 20 individual checking accounts so you can separate income, taxes, payroll, and savings without any extra complexity. Each bucket is its own account, and you can see exactly where your money stands at a glance. You can also schedule and send payments directly through Relay, whether by ACH, wire, or check. No logging into a separate tool to pay vendors, no chasing invoices across different platforms. What I really like is the team access. You can give your bookkeeper, assistant, or partner their own login with specific permissions, so they can handle what they need to without you sharing passwords or losing visibility. Relay connects directly with Xero and QuickBooks, so your books stay clean and audit ready. You can even snap a photo of a receipt and store it instantly, so every purchase has proof right where you need it. If you want to take control of your business finances, scan the QR code on screen or use the link in my description to open your Relay account today. Okay, so the first problem, and the one all the others get to hide behind, is that retirement accounts have quietly become the perfect bag holders. On paper, they are an extremely well-behaved pool of capital. 401ks and IRAs both carry a 10% early withdrawal penalty on top of regular income tax, which means most people don't touch them until their late 50s at the absolute earliest. That gives the funds managing them two things Wall Street genuinely loves: an extremely long investment horizon and extremely predictable liquidity needs. The fund manager doesn't have to worry about a flood of people asking for their money back tomorrow, which is perfect for owning illiquid assets like commercial real estate, private businesses, and private loans that are all very hard to sell quickly. These funds are also enormous, which means they can get into deals that most individual investors couldn't access even if they wanted to. On top of that, the fund managers running them are compensated for hitting steady returns inside a narrow risk band. And on top of that, most of the actual humans whose money is in these accounts have no idea what they are invested in, what the fees are, or what the real risks look like. Put all of that together and you have a customer that is captive, enormous, patient, oblivious, and politically impossible to let down. Because of this, more complex and illiquid products have actually become more desirable, because they simultaneously make it look like intermediate fund managers are justifying their own existence, but it also makes day-to-day price shocks harder to recognize as compared to something like a stock portfolio that has market pricing information updated thousands of times a second. We saw a version of this with mortgage-backed securities in the lead-up to 2008. Pension and retirement funds were quiet, but also enormous holders of the tranches that blew up. More recently, it's been private credit and BDCs being aggressively marketed into target date funds. And now, after last year's executive order, the big push is to make private equity and crypto products directly accessible to every 401k plan in the country. The same trillion-dollar private credit industry that has started to run out of good borrowers, looking at a $14 trillion pile of captive 401k money and seeing an exit door. And it all works because whoever gets to hold that money also gets to hide behind the phrase, "that's people's retirement," when things start going wrong. Now, to play devil's advocate, this wouldn't necessarily be a problem if people actually paid attention to where their retirement was being invested and were willing to accept those risks. But this issue also needs to be considered alongside the other problems with treating retirement savings as an endangered species that must be protected at all costs. So yeah, the second problem might not be that shocking to you, but it still needs to be considered. And that is that retirement savings held in these advantage accounts are overwhelmingly held by already very wealthy households. According to the Federal Reserve's most recent survey of consumer finances, the top 10% of American households hold the overwhelming majority of all retirement account balances. The top 1% on their own hold more in these accounts than the entire bottom half of the country combined. And to be fair, that bottom half of households have, on average, basically nothing in dedicated retirement accounts at all. The point is that when a politician says we have to do X because that's people's retirement at stake, the retirement actually being defended belongs overwhelmingly to people who are going to be fine anyway. The phrase "people's retirement" sounds like it is defending a plumber 3 years away from clocking out for the last time. In practice, it is defending the ancillary portfolio of someone who statistically already has a healthy base of personal wealth. Now, for what it's worth, this breakdown of retirement savings is actually a more equitable distribution of wealth than direct stock ownership, which skews even harder to the top. This is often used to highlight the power of these accounts to make long-term investing more equitable across all workers in the economy, but this still has some problems. For one thing, being slightly more equitable than regular equity holdings is not exactly a ringing endorsement. The second thing is that the households with a majority of these assets held in retirement accounts are largely the same households holding a majority of directly held assets as well. So really, instead of bridging the gap, it's adding further distance between these percentiles. And finally, well, you may be personally fine with this kind of inequality of asset ownership. At the end of the day, we do live in a theoretically capitalist, free market economy, and some level of inequality is just inherent in that system. But the difference is with regular asset markets, their inequality isn't tax advantaged. So yeah. Problem number 3 is that because these are tax-advantaged accounts, every dollar going in is a dollar that gets omitted from government revenue. And this is not a small issue. According to the Joint Committee on Taxation, retirement account-related tax breaks cost the federal government $383 billion in fiscal year 2025. This is a cost that is much harder to see because it is omitted revenue that just never comes in, rather than a budget line item that comes directly out of the Treasury. But to put that into context, $383 billion is more than the federal government spends on SNAP, unemployment insurance, child nutrition, and federal family support programs, combined, with enough left over to fund NASA as a cherry on top. To address this even more directly, it is also enough to just cut a $7,000 annual check to every single American over the age of 67. Now obviously, that is not going to fund a retirement by itself, but it would be a serious top-up to Social Security for every senior, regardless of whether they had spent a career maxing out a 401k or not. Now again, to play devil's advocate here, the argument is that these tax breaks encourage regular workers to save, which takes pressure off the governments to support them later, which might actually be a decent argument, if the tax benefit was spread evenly. But by combining problem 2 with problem 3, it really isn't, because the tax break scales with how much you can afford to contribute, and that scales with how much you earn. The vast majority of that $383 billion flows straight to people who are going to be financially comfortable in retirement either way. Of course, there are extreme examples of this, like Peter Thiel compounding billions of dollars worth of Facebook stock in his tax-advantaged Roth IRA. But more broadly, the majority of these advantages go to people who just don't really need them. It is a subsidy that gets sold as protecting the working class. It is, in practice, a transfer to people who can already afford to invest even without the tax breaks. Now, on top of that, there is the argument that a private sector funded retirement is simply more efficient than a bloated government system without a profit motive. But the alternative is not exactly flawless either. Just because they have a profit motive doesn't mean it's your profit motive. Privately managed retirement accounts currently pay out tens of billions of dollars every year in management fees to the financial institutions moving all that money around. An exact number is hard to find, because the financial sector surrounding these retirement accounts is so massive. But a report by McKinsey estimated that roughly $84 billion in fee revenue could be directly attributed to direct contribution retirement accounts in 2024 alone. Those are all expenses that are not going to fund anybody's retirement, let alone the people that really need it. But even this is not the real problem. The real problem is that this whole arrangement was sold on one specific premise. It put people's financial destiny back in their hands. They are the ones taking the risk. They are the ones investing in markets. They get the upside. And yes, sometimes they will have to eat the downside. Again, to be clear, there is a certain appeal to having control over your own finances and not relying on an employer to pay you out a fixed monthly stipend. But that premise is, being honored very unevenly. Because the fourth problem, and the one that ties this whole system together, is that the people using these accounts are not actually being allowed to take the risk they are supposedly being rewarded for. Every time a sector of the financial industry that retirement funds have heavily piled into starts looking wobbly, the government steps in. Sometimes it's direct bailouts. Sometimes it's emergency liquidity. Sometimes it's quiet regulatory forbearance. Sometimes it's the Fed buying up an asset class that was never supposed to be its problem. In every case, taxpayer resources get deployed to keep something propped up because letting it fail would hurt, well, people's retirement.
And protecting Americans and their retirement accounts.
This new bill would make it easier to save for retirement.
Second panel will focus on protecting Social Security forever and strengthening retirement security for all Americans.
That is not, strictly speaking, private enterprise. That is a private investment account with a public guarantee quietly tacked onto the back end by political pressure. And the guarantee doesn't only show up as bailouts. It also shows up as red tape being cut, worker protections watered down, consumer protections weakened, and antitrust enforcement going quiet. All under the same argument. If we make this industry play fair, it might get less profitable, which might hurt stock prices, which might hurt 401k returns, which might hurt people's retirement. That was an incredibly effective lobbying tool, which is how you end up with a 20-year stretch where corporate profits hit record after record, wages stagnated, housing got unaffordable, healthcare costs exploded, and every attempt to regulate any of it got batted down by the same line. For the vast majority of Americans, stronger worker protections, genuine consumer rights, and a housing market that isn't an asset class first would be worth enormously more than a few extra basis points on a retirement account they mostly don't have much in. But the basis points come with the lobby. The protections do not. Now, the one piece of genuinely good news in all of this is that America is not even close to being the worst offender. Australia, for example, has a mandatory retirement scheme called superannuation, where a percentage of every worker's paycheck is legally required to go into a private investment account. That has given Australians the highest per capita retirement savings on the planet, and also a pool of private capital so enormous that the Australian government now treats it as a kind of general-purpose piggy bank. If the Australian economy is known for one thing, it is most likely its incredibly unaffordable housing market. But that market could only get so bad because Australian banks were willing to lend so much, and they were only willing to lend so much because they were so well financed, and a big part of the reason why they are so well financed is because Australia's enormous pool of retirement savings funnels a lot of that money into these institutions either directly through bond holdings and deposits or indirectly through equity. Data from the Australian Bureau of Statistics suggests that out of every dollar that gets put into these accounts, 27 cents gets directed towards the country's banking sector, which is in turn heavily focused on residential real estate mortgages. Or, when that isn't direct enough, these superannuation funds have also just cut out the middleman entirely and started investing in single-family homes themselves. In plain English, a large part of their infamous housing problem is funded by, and it is currently funding, the tax-advantaged retirement of primarily wealthy investors. It sounds bad, but it has also become a strange emergency fund for all the wrong reasons. Young Australians can now access their retirement savings to put a deposit down on a house, further adding tax-deferred fuel to that particular dumpster fire. Australians were allowed to withdraw tens of billions from their superannuation as pseudo-stimulus during COVID, and there has been a growing push to tap it to help finance the country's expanded military spending as well. So the good news, such as it is that we have not yet reached the point of using 401k balances to directly fund defense procurement. We are still just using it to bail out private equity. Which brings us back home, and to the uncomfortable bit. The obvious fix for all of this is actually not that complicated on paper. Stop letting the riskiest possible products into tax-advantaged accounts. Means test the tax breaks so they stop being a handout to people who are going to be fine already. And stop accepting that's people's retirement as an automatic veto on any policy that might force Wall Street to behave or companies to face consequences. Of course, Wall Street is not the only business that has learned to make itself impossible to touch. The most expensive example of all might be the hospital. I know it's not going to come as a shock to any of you watching when I say that the healthcare industry in America is incredibly broken. We spend almost double most other advanced economies, and yet we have measurably worse outcomes, lower life expectancy, higher infant mortality, more easily preventable deaths, far lower early intervention methods, not to mention the general stress that goes along with the trip to the hospital, which means a lot of people just don't go until it's too late. Now again, I know none of this is shocking to you, but these frictions, failures, and financial incentives have all become so ingrained into a system that has in turn become so ingrained into our country that it raises a rather concerning question. Would it even be possible to unfuck the healthcare system without destroying the economy in the process? The USA is the largest market in the world thanks to the disproportionate share of our economy dedicated to consumer spending. This is a statistic that even I have highlighted here before on this channel, because it makes us look like we just love buying overpriced trucks and useless consumer junk. And while maybe that's still true, if you remove healthcare spending from this equation, we are actually right in line with most other peer countries. Put another way, if we actually demolished the healthcare system and built something somewhat efficient in its place, we would cut out as much as 10% of our GDP. Now, 10% of our entire economic output going towards spinning the wheels of medical bureaucracy isn't great, but this broken window still represents millions of jobs, not to mention a lot of our financial system. They might contribute nothing outside of justifying their own existence, but now that they are there, they are extremely hard to remove. Now, I know what you might be thinking. Just because something is hard doesn't mean we shouldn't do it. And even for the people who don't believe in socialized medicine, the bureaucratic bloat in healthcare is still a problem. But it's also important to realize that no policymaker wants to preside over millions of lost jobs, even if it would fix one of the biggest ongoing burdens on the nation. Oh yeah, and one last thing. Before all of you non-Americans start feeling too smug about the rock and a hard place we have wedged ourselves into, it's probably worth exploring how we have exported this issue across the world to the point where there is a pretty good chance we are making your health outcomes worse as well. Now, before we get into it, I think a bit of context is in order. About 5 years ago, I was personally very much a part of the problem in this industry. I worked as an investment banker specializing in businesses operating specifically in healthcare. The scale of the regulations and business activity that takes place in the system between you and your medical care was big enough that several firms could specialize in just serving these companies. The fact that several investment banks can be kept afloat just off the fees they charge as a middleman on transactions between other middlemen in the medical industry should give you a sense of just how much bloat has been piled onto the end goal of treating illness. In fact, the broken incentives, lobbying, anti-competitive business practices, and simple entrenched interest was part of the reason why I started this channel to begin with. It's easy and honestly a little bit cathartic to anthropomorphize the players in this game and group them into heroes and villains. But to get a good understanding of the problem, it's a lot more productive to follow the simple conflicting incentives that have logjammed the system so badly that it's basically impossible to get things done without stepping on someone else's toes. So in the interest of fairness, I want to start with the doctors themselves, because of course, typically they get much less blame than something like an insurance company, because well, they actually achieve something. But they still have incentives of their own and bodies that lobby aggressively to protect those interests. Becoming a doctor, and especially a specialist, takes a long time, and puts most students into a massive amount of debt. According to the AAMC, the median medical student was graduating $205,000 in debt, and that's accounting for some people who were able to get a scholarship or had parents to fund their education. For students going the private college route, that number can be as high as 400,000. To compensate for these immense upfront costs and several years of lost earnings compared to their peers, it's always been the expectation that American doctors are paid extremely well. And on average, they are. Physicians in America are paid on average almost double that of other OECD countries, and even extremely high-income outliers like Switzerland. Oh, and as something of foreshadowing, you might have noticed that Canada is right up there with us, but more on that later. In a lot of other countries, being a doctor is still a prestigious and highly respected job, but it doesn't come with nearly the same expectation of earnings. And in America, this wasn't by mistake either. The American Medical Association, which represents physicians, has lobbied Congress relentlessly to limit residency positions for students graduating from medical school. The Medicare graduate medical education funding has remained more or less intact since 1997, but during that same time, we have added 70 million people to our population. This has all limited the supply of doctors to the point where the AAMC estimates that we will have 139,000 fewer physicians than we need by 2033 as our population continues to age. But on the demand side, there has been just as much meddling. One of the other big pushes by the AMA is to make sure that there are lots of things that can only legally be done by a doctor, even when they could be done by a nurse practitioner, a physician assistant, or a non-physician specialist like an occupational therapist for a lot of this work. Now, of course, something like brain surgery should probably require a specialist to be present, but a lot of the tasks that legally only doctors can perform really aren't that important or that sensitive. One of the most egregious examples of this scope creep is the amount of time that doctors spend justifying routine prescriptions and procedures to health insurance providers. Now, despite being some more foreshadowing about how bureaucracy creates bureaucracy, even if this was all totally necessary, most of this work is simple data entry, which could easily be done by a trained receptionist. But because only doctors are deemed worthy of these specific tasks, they have to spend their valuable time filling out online forms, a cost which is ultimately passed along to their patients. America has by far the highest medical administration cost per capita anywhere in the world. We spend more than triple the runner-up, which is Germany, and bureaucratic administration is basically their cultural identity. Mandated inefficiency is just one of the causes. A simple combination of bottlenecking the number of doctors entering the field and then wasting their time once they are there means that their hours become extremely valuable. Medical schools have realized this, which means that they can charge more. And even the doctors themselves, who largely do just want to help people, aren't going to turn down a far higher than average income, because they need it to pay off their far higher than average debt. The same goes for things like indemnity insurance, licensing, and training. All of these things can be expensive because doctors are paid well. But doctors need to be paid well because everything they do to maintain their professional standings is expensive. But alright, so far all of this is still only counting the groups that do still largely want to help people. And of course, these little inefficiencies have snowballed into something much larger. There are fewer than 1 million direct patient care physicians in America, but over 20 million people employed by the healthcare industry in total, with an alarming share doing very little in the way of actually caring for anybody's health. So another group that is often overlooked in this whole equation are the hospitals themselves. Like a lot of things in the economy, hospitals and practices have become another entrenched strain on the system simply because of how consolidated they have become. Medical groups have become so dominant in certain areas that patients effectively have no other options if they want a certain procedure outside of traveling several hours. At the same time, the number of doctors that run their own private practice has been consistently shrinking, as the industry pressure has pushed doctors into these collective health systems. Oh, and well, you know I had to bring it up eventually. But the Government Accountability Office has also pointed out the role of private equity in strategically buying up regional medical practices to create local monopolies on care. Now, anti-competitive practices are nothing new in any industry anymore. The FTC has been infamously flaccid with their enforcement for the last 45 years. But the medical industry in particular gets away with a lot more than it should for two specific reasons. The first is that healthcare is complicated. The average regulator hasn't been to medical school to argue against industry groups claiming that a merger is necessary for patient outcomes. The second is that the actual costs that come out of these mergers are extraordinarily opaque. Of course, public enemy number one in this whole game are the private insurance companies, and don't worry, we will get to them soon enough. But a lot of these combined groups have become so large that not even insurance providers can push back against their market power. If a hospital system has a monopoly over a critical medical service in an area, people will change their insurance if their current insurance provider doesn't cover that network. Large insurers do have more negotiating power than individual payers, but if a hospital is the only game in town, there really isn't much they can do. This consolidation has also pushed insurers into all-or-nothing contracts, where large health systems will require insurers to include all their facilities in their coverage, including the expensive ones, or else they won't provide access to any of them. Now, obviously, health insurers aren't the victim here, but in certain areas, this does prevent them from making a narrower network of providers just offering basic services for a potentially more cost-effective plan. All-or-nothing contracts also incentivize hospitals to provide services that may not have been demanded, even by the massively distorted market, since they are being strong-armed into covering it anyway. Even for services provided to patients on Medicare, there are logical incentives that push up prices. One of the key groups that decide how much a medical service should cost Medicare is the Specialty Society Relative Value Scale Update Committee. A bit of a mouthful, so it's normally called RUC. This is a group of 31 physicians who volunteer to provide guidance on how to value a physician's work for computing healthcare prices. Now, naturally, a group of physicians would like to say that physicians are worth quite a lot. But this group is also overwhelmingly made up of specialists, creating a bias that overvalues specialist procedures over simple primary care. Now, the reason why this is important is because the prices this group lays out are almost always adopted by Medicare, and the prices adopted by Medicare act as a price floor template for the rest of the industry as a whole, with various built-in markups. Honestly, it's not too dissimilar to how government treasuries determine the rates that people pay on their home loans and credit cards. All of these conflicting groups obviously create a lot of friction in an already very complex industry, which also allows for other groups to cash in ways that are harder to notice with everything else going on. Pharmaceutical companies make roughly 40% of their global revenue here in America, even though we have 4% of the world's population. It's no secret that we massively overpay for medicine, but within this whole mess, who's going to notice? The US market has become so lucrative that we have effectively subsidized R&D for the rest of the world, because selling a new drug to Americans is so profitable that every other country can basically just break even. And then, of course, boxing this whole thing in are health insurance companies, which may get some pushback from some of the big healthcare groups, but can still ultimately pass everything along to regular consumers, in costs that are usually obfuscated by employer healthcare plans. These guys keep everything out of sight and out of mind for most people, until they actually need to deal with it. And then, of course, they have an incentive to delay, deny, and defend. Even if it did function without this logjam of conflicting interests, healthcare is never going to be a normal market. The information asymmetry is huge. The groups paying the bills are rarely the ones receiving the support. Prices are borderline impossible to find, and even if you could get access to this information and actually understand it, you can't shop around while you're dying. Now, it certainly doesn't help that the regulators who should be in there trying to direct this traffic jam towards something slightly more functional are being paid off by these various parties to let them get a little bit further ahead in traffic at the expense of making it impossible to fix the system as a whole. According to Open Secrets, the healthcare sector is the #1 lobbying spender in the country, spending almost $750 million in 2024 alone, just at the federal level. But now the thing is, this has been going on for so long that even if it was completely fixed and ironed out tomorrow, there is too much built up in it. Every one of these groups employs tens of thousands of people to negotiate, coordinate, lobby, market to, or just plain old sue all of the other groups. Each and every one of these groups is just trying to serve their own self-interest, but none of those interests are aligned, and the group that is consistently made to compromise is the patient right in the middle of everything with the least understanding and negotiating power. Another slightly darker visual metaphor is that often rats will get their tails caught together, and as they run to try and free themselves, they only end up pulling the knot tighter. Collectively, this administrative bloat built to service the administrative bloat is one of the largest employers in the country, and, at least up until recently, has been one of the only industries safe from layoffs. If we could snap our fingers tomorrow and replace our healthcare system with something like what exists in Australia, we would lose 7.5% of our economic, productivity, and shed millions of these jobs. It's also worth noting that Australia's system is not exactly an unfair comparison. They also have very well compensated doctors on average. They have extremely good health outcomes and rely on a blended system of private health insurance and public Medicare. Either way, this would be a larger hit to both of these numbers than the global financial crisis. However, that doesn't mean it's not worth trying, because over time, this problem is only getting worse. The size of the healthcare industry has consistently been growing faster than the size of the overall economy. By 2033, the Centers for Medicare and Medicaid Services predicts that more than 1/5 of our entire economy will be dedicated to healthcare and the apparatus that is built up around it. But just like healthcare has slowly grown on the economy, it can also slowly be disassembled over time as well. Simple things like antitrust enforcement, proper lobbying regulation, and more transparency will at the very least deal with the elements that are intentionally trying to pile more logs into the logjam. We may lose some jobs like internal auditors for the legal firms, servicing the investment banks, managing the deals between market information providers, giving leads to pharmaceutical sales businesses that sell third-party generic substitutes to regional healthcare groups, but that's just measuring the downsides. One of the biggest hurdles to skilled professionals starting businesses of their own is losing the healthcare security that comes along with being a skilled professional. Removing one of the biggest obstacles to genuine business development in the long term would be far healthier for the economy than piling another layer of administration on top of our healthcare system. Finally, it might also solve what some consider to be one of the most existential problems in the world. We aren't having enough babies. But when a visit to the hospital can be bankrupting, maybe this shouldn't be too shocking. Especially to the same group of people who want to replace us all with AI anyway. Which is a real problem because at the exact same time, the largest generation in history is heading into retirement all at once. And I can't overemphasize how much I love the name of this report, Peak Boomers Impact Study found that between this year and 2030, 30 million Americans will retire, representing almost a fifth of the total labor force. The study focused primarily on how those retirees plan to fund their retirement, and the results were grim. More than half of the study group had less than $250,000 in assets, including their home if they had one, and that group would rely on Social Security as their primary or exclusive source of income in retirement. Now, this study was conducted by independent researchers, but it was funded by a group that wants to sell annuities to people planning their retirement, so some of their recommendations need to be taken with more than a bucket of salt. However, the study group of retirees getting too old to work are just one part of the larger group deciding that right now is a pretty good time to retire. A study by Pew Research has found that the largest wave of retirement has already happened, as people step back from the workforce during COVID, assisted by a combination of record low interest rates, generous stimulus measures, redundancy packages, record asset prices, and a general motivation to not go back into a plague-infested office. This is far from a uniquely American trend. In fact, we are actually behind a lot of countries that are both older than us and have better support systems for people in their old age. On top of hitting peak boomer, there are less typical retirees. A growing number of independently wealthy young people who are pursuing financial independence where investment returns from their assets are enough to fund their lifestyle indefinitely, and on the other end of the spectrum, there are people just giving up on working and are scraping by on family support, government assistance, or jobs in the informal economy. These people aren't the typical demographic of retirees, but they are still adding to the record trend, and they are all paying for this major financial decision in slightly different ways. The first way is that they just aren't. People don't always make entirely rational financial decisions. Whether it's buying a car in an 84-month finance deal, racking up credit card debt to buy luxury goods, or just not understanding the importance of saving and investing, there is no shortage of people doing really dumb things with their money. You are watching a channel that gives weekly depressing lectures on the state of the financial system, business trends, and the economy. So all of you are probably far more financially literate than the average person. And even then, you have probably made some dumb money mistakes. People deciding to quit their jobs often aren't thinking entirely rationally. And more people are just deciding that if they are going to be screwed financially in their old age, they would at least like to enjoy a few years while they still have their health and worry about finances once they are too old for it to be their problem. For some people, the decision is made for them. Layoffs nationwide have hit people approaching retirement age particularly hard. According to a survey conducted by the Transamerica Center for Retirement Studies, most Americans are retiring 5 years earlier than they expected. While this sounds like it's giving people more years to enjoy themselves, the reality is that it's giving people fewer years to save and more years to cover, and this is almost entirely involuntary. According to a study published by ProPublica, since 2016, 56% of workers over the age of 50 lost their job involuntarily, meaning they either got fired, made redundant, or laid off. Now, that might not sound too bad. But you have to remember that a lot of people over the age of 50 are choosing to leave their job because they are retiring on their own terms. So the majority being let go is pushing a lot of people out of work. Once they are out, older people are finding it much harder to find a job, especially ones that pay as well as the jobs they were laid off from. Companies don't want to hire older people because they think that they can't use computers, they aren't going to be able to do physical work for as long as young workers in non-office jobs, and there is the not-so-secret reality that older workers are normally less easy to take advantage of than younger workers with their whole career ahead of them. It's technically not legal to discriminate against workers over the age of 40, although this law does not protect against discriminating against people under the age of 40. But that's a whole separate issue. It doesn't matter anyway, because any half-competent hiring manager or human resources department could find a reason for hiring a young worker instead of an over 50 worker, and this all means the same thing. If people lose their jobs over the age of 50, they are almost forced into retirement whether they can afford it or not. The topic of what to do with aging populations in countries across the world is something that is keeping a lot of policymakers up at night. People are living longer and having fewer children, which means more pressure is going to be put on a smaller group of young people, or elderly people are going to have to make do with less. Of course, a lot of baby boomers are independently very wealthy as they have enjoyed a high level of job security and incredible asset price appreciation over their working careers. A typical white-haired couple driving a gold buggy around a gated Floridian retirement village might be the first thing you think of when you think of boomer retirees, but these people are far from the average. People of retirement age own more than half of the wealth of the country, but that wealth is spread even more unevenly than it is over the general population. There are some extremely wealthy baby boomers, a small group of boomers who will be able to comfortably fund a nice retirement, and millions who are fighting for what little is left. The question is really about what happens when this group just can't work anymore. A study by the Stanford Center on Longevity found that even though baby boomers are the wealthiest generation in history as a whole, they are still facing tougher retirement conditions on an individual basis than their parents did. Some countries are pushing back retirement ages to squeeze a few more years of work out of people before they can receive a government pension or access their Advantage retirement savings accounts. Statistically, most of you watching this video are either at the peak of your career or are only just starting, which is why we have covered the problems you are likely to face if you don't already have a solid plan to retire. But even if pushing back retirement benefits is a necessary evil, it's going to be a hard sell. Retiring baby boomers are a large group, and they vote. The very mention of them needing to work a few more years is borderline political suicide. Most plans here in America center around pushing back retirement for young people who aren't close enough to retirement yet to care. Whatever the plan is, it's not being helped by the millions of people who are dropping out of the workforce. So, the compromise is that the payments are stretched thinner. According to Census Bureau data, poverty rates amongst people over 65 has been on the rise as government programs haven't been able to keep up with general inflation, and certainly haven't kept up with the spiraling costs for aged healthcare and senior living. If people do re-enter the workforce, it's normally into low-wage jobs that only help support other payments. A study conducted by the American Society of Aging found that a fifth of older workers were making less than $15 an hour, and that included people between 55 and 65 who should be at the penultimate years of their career. The authors of this study also pointed out that a lot of this low-wage work is intense, routine, and almost always highly monitored in situations where a person controls neither the pace nor content of their work. Now, you probably don't need an institutional study to tell you that minimum wage jobs are hard. But they are even harder on old people with deteriorating health, which means it could be hard for them to keep this work even if they really need it. When this happens, the last line of support becomes relying on their adult children for care. Now, the idea of your parents moving back in with you might be terrifying enough, but the burden of being a caregiver to elderly parents is disproportionately falling on lower-income households. Lower-income households are less likely to be able to save adequately for retirement and are more likely to have children that are also low income. When those parents start requiring care from their children, it can impact relationships, career growth, or even how many hours the adult child can put into their work. Additionally, a dependent parent might be a direct financial burden if their assistance payments don't cover their expenses. This means the children are going to be less likely to save for their own retirement, creating a vicious intergenerational cycle. So what was supposed to be a feel-good story about millions of people leaving behind the 9-to-5 has turned into a lecture about the grim financial landscape that millions of people are forced to contend with. Welcome to this channel. By now, you should know what you have signed up for. But what can be done about this? As a society, not much, unfortunately. A lot of incredibly smart people are tackling the problem of aging populations, and the solutions so far have been to get people to work longer and live on less. Individually, though, you need to assume that there is not going to be anything there to support you when you are too old to work. Pensions are already strained, and if you have a few decades left in the workforce, there really is no guarantee it will exist at all for you. And if it does, it's probably only going to be enough to cover the bare necessities, if that. So try to set something aside in a 401k or whatever the equivalent is in your respective countries. It's basic stuff, but when so many people cannot or will not do the basics, it could put you a long way ahead. Of course, some people are counting on not having to save at all, because they expect to inherit a slice of the biggest pile of money in history. In the coming decades, the wealthiest generation in history will die. It's an unfortunate, albeit inevitable fact of life, but baby boomers will eventually go extinct, and they will pass down over $90 trillion to the next generation within America alone. This much money could fix a lot of problems like student debt, unaffordable housing, inadequate retirement savings, and record credit card debt. But don't get too excited just yet, because at best, the Great Wealth Transfer is a financial illusion, and it could actually just end up making things worse. Baby boomers are the wealthiest generation in history. In America, they control half of the nation's wealth, according to the 2024 Wealth Report prepared by the property management company Knight Frank. Other sources estimate that baby boomers only hold a mere $78 trillion in assets. That slight difference of $12 trillion is due to what you really define as wealth, and that slight difference in opinion is more than the collective wealth of half the planet. Regardless of the exact methodology used to calculate generational wealth, they all agree on one thing. Baby boomers are the kings, and everybody else has been holding on to whatever is left over. That concentration of wealth has, according to many, come at the expense of younger generations who are now poorer than their parents were at the same age. So that means when life finds a way and this wealth is passed down, it should fix these generational issues, right? Wrong. Counting on an inheritance to fix your own personal finances is a terrible idea. According to a survey by the investment intelligence firm Natixis, 70% of young people expect to get an inheritance, but only 40% of their parents actually plan on leaving one. This means individually, 30% of the young adult population is going to have their financial plans ruined late in their careers when there isn't much time left to make up for it. Okay, so waiting on an inheritance is a dumb thing to do as an individual, but counting on the Great Wealth Transfer globally is just plain irresponsible for 3 simple reasons. The first is that not all wealth is created equal. $7.4 trillion of the $90 trillion total are held in private businesses, according to data from the Fed. Small operations like HVAC, roofing, machining, mortgage brokering, medical practices, and repair businesses number in the millions across America, but putting a value on them can be extremely tricky. The Fed took estimated EBITDA for these companies, which takes the earnings of a business before interest, taxes, depreciation, and amortization, and then multiplies that by an industry standard valuation multiple. If you own a small business that makes $200,000 per year before these other costs, and you operate in an industry like machinery with an industry EBITDA multiple value of 5, then congratulations, your business is worth $1 million. This is an imprecise art. And naturally, a business is only worth as much as someone is willing to pay for it, which will only cause a problem when all of these boomer-owned businesses get passed down to the next generation. According to the American Medical Association, 49.1% of physicians currently work in practices where the owner is themselves a doctor. That was down significantly since the start of the pandemic, and many of those left are owned by doctors that have had time to get the experience, clientele, and capital necessary to go into business for themselves. If they retire or die, their business doesn't have any value to their children unless they themselves are also doctors in the same field of medicine, an exceedingly rare occurrence. Millions of other owner-operator businesses will close their doors before they can be passed down to younger generations. Now, this is a bigger problem than some trust fund babies not getting handed a free business. If these businesses disappear, it will not only take their services out of the market, it will also stop new entrants into the job market from getting apprenticeships to learn the trades that are already in desperately short supply. But in crisis comes opportunity. The first group that is actually benefiting from the Great Wealth Transfer are investment firms that are buying up these small firms for pennies on the dollar from owner-operators who just want a bit of extra cash before they retire. In a process called rolling up, private equity firms are buying dozens of small businesses and then merging them into one more efficient business that can hire cheaper employees to service the clients of all the old businesses. Sites like BizBuySell, BizQuest, and BusinessBroker.net have become the eBay for small businesses, largely listing businesses owned by retiring baby boomers who are hoping to get something rather than just shutting them down. There is one other problem with all this private business wealth too. The 50 largest private companies in America are all almost exclusively owned by baby boomers. Without the financials of these private companies, putting an accurate value on them is almost impossible. But based on comparables, these top 50 are collectively worth an estimated $2 trillion, conservatively. So, almost half of the wealth in this asset class is just 50 companies. Unless your family name is Bloomberg, Mars, or Coke, the value of the boomers' private companies is not something that is going to impact your life. But that's only one small part of the great wealth transfer. Boomers reportedly own $16.9 trillion in durables and other assets ranging from rusty old home appliances to motor yachts. Some of these goods could be sold by a beneficiary, but a lot of this paper wealth is, in reality, going to end up being a financial burden to maintain if it's not just simply disposed of. Rounding out the wealth that might not do much good to the next generation, pension plans have been calculated on what they are worth to the boomers themselves based on assessing how much money someone would need to replace that cash flow. A pension that pays out $50,000 a year to a retiree could have an on-paper future value of $1 million. But that doesn't mean that a beneficiary is going to receive $1 million when their parents die. So with that, the great wealth transfer has already been cut in half. But that still leaves $40 trillion in cash, equities, and most importantly, housing that is going to be passed down in the coming years, and that's gonna fix a few things, right? Baby boomers' second largest asset class is their homes and investment properties. The generation owns almost as much real estate as the Generation X and Millennials combined, and controlling this much of the market has caused problems for everybody else. According to a survey conducted by the real estate firm Redfin, about half of homeowners and renters said they have periodically struggled this year to afford their mortgage payment or rent as rates have increased and have been passed along to the people on the bottom of the housing ladder. The survey also found that to keep up with payments, some homeowners and renters had resorted to selling their belongings, picking up overtime shifts, canceling vacations, working a second job, and even skipping meals to keep up with their payments. Housing has simply become a major expense for everyone, except for those who have had the opportunity to purchase a home when they were affordable and the time to pay their mortgage off in full. The great wealth transfer of housing on the surface looks like a ghoulish, albeit pragmatic solution to this problem for two simple reasons. The first is that it could provide millions of people with a house of their own to live in. The second reason is that even if you receive a home as an inheritance that you don't want to live in, you can just sell it, which is good for you and good for the market because it provides supply at a time when almost nobody wants to sell their home. So, what's the problem then? Well, again, less housing than you would expect is actually going to be passed down. A study published by the National Library of Medicine has found that a majority of lifetime healthcare costs for the average person happens after they turn 65. This is an immediate problem, because according to a study by the health research organization KFF, only half of people over 65 have anything saved to pay for healthcare costs in retirement, and the overwhelming majority of adults won't have enough money to pay for senior living care, which is now estimated to be over $100,000 per year. Medicare, which is the government-provided health insurance program for seniors, does not support senior living. So, many seniors will add a Medicare Advantage plan, which is an additional out-of-pocket expense. So housing will be handed down, but it's primarily going to be handed down to reverse mortgage companies or sold to cover spiraling senior living costs. According to Freddie Mac, the total value of cash-out refinances and second mortgages has already doubled since 2019, as even people who do own their own home have trouble keeping up. So far, the great wealth transfer is going to consolidate small businesses, financialize homes even further, drive up medical costs, strain government services, and increase household debt. But there is still hope. There is one asset class left, and it's the biggest of them all. Baby boomers hold on to more equities and fixed income securities like stocks and bonds than millennials have between all of their assets combined. But when you think about it, that doesn't really make sense. For most people, their biggest asset is their home. Participation in the stock market is at record highs thanks to investment vehicles like 401ks and IRAs, as well as technologies that make investing easier like cheap online brokerages. According to the Fed survey of consumer finances, 58% of households owned stock in 2023, which is a good thing. But it's still lower than the 65% of households that own their own home. Part of this can be explained by people buying stocks because they simply can't afford housing, but that's only a minor factor. This class of assets will actually be handed down in the great wealth transfer, but it doesn't belong to normal people. Despite record participation in the market, the richest 10% of Americans now own 93% of stocks. The bottom 50% of Americans own just 1%. Most shockingly of all, though, the stock market inequality is even more severe amongst baby boomers. Just Bill Gates, Jeff Bezos, Elon Musk, Steve Ballmer, Larry Ellison, Michael Dell, Jensen Huang, and the 3 surviving Walmart heirs own roughly $1.9 trillion worth of stocks, or 10% of all the equities within their generation. The remaining 70 million baby boomers own the 90% that these 10 people have left behind. The good news for the people in line to inherit a majority of this wealth is that they won't need to wait for it. A New York Times article detailing the way that this wealth is being transferred has found that most of the advantages of the Great Wealth Transfer have already been handed to the people in line to receive it. A growing trend of giving while living means that children from wealthy families with the financial means to maintain their wealth until their death are already getting their college paid for, assistance with buying their first home, and cash to cover the cost of raising their own children. According to a survey from the UK, nearly 80% of children enrolled in the country's private schools had at least part of their fees paid for by their grandparents. If you are in a financial situation where you need the Great Wealth Transfer to help you out, the Great Wealth Transfer probably isn't going to help you. So if the inheritance is not coming to save you, you are left with the old-fashioned plan. Work hard, save up, then retire comfortably on your own money. Except that plan is breaking down too. There are countless stories of people with good jobs and diligent savings patterns still needing to work well into their twilight years. This is to say nothing of people that unfortunately never have the privileges of higher education or a stable career. Recent reports have found that less than 30% of American workers are on track to retire at all, and even fewer think that they will have a comfortable retirement, and they might be right. I know you didn't want to hear this, but there are a few big factors in the world today that are acting to keep most younger generations in the workforce indefinitely. This is all before considering the major hiccup that the COVID-19 pandemic has been. A global event that has actually worked to widen the gap between younger generations with fewer assets and more precarious employment versus older generations which tend to be more secure. Now, you might think that you are different. You contribute to your 401k, save diligently, subscribe to How Money Works, and even invest regularly into the stock market. Well, that's all great, but I might still have some bad news for you. There are lots of issues at play here: housing, the stock market, and a series of broader economic conditions which might threaten the general assumptions we make about indefinite growth. The obvious first culprit is housing. Affording a home has become a major challenge for most workers in the USA. I know this problem is nothing new, but there are still a few very important factors that people don't consider. Even very high-income earners that graduate from top universities and go into fields like investment banking or big tech tend to be moving to equally high cost of living areas like New York, Chicago, or San Francisco. Pew Research recently reported that a majority of young adults between the ages of 18 and 30 are now living at home with their parents. The median age of a first home buyer in 2019 was at 34, and experts agree it's almost inevitable that figure will be pushed even higher by the pandemic. What's more is that young buyers tend to be purchasing smaller dwellings like apartments and townhouses rather than traditional freestanding family homes, not because they don't want to, but because they can't afford it. This is a real issue because most financially secure people will tell you their house is their biggest asset. This doesn't just mean it's the asset that they own that's worth the most money either. Owning a house means you don't have rental expenses, and even if you are paying a mortgage, those payments will at least partially be building up equity in the home itself. What's more is that once the mortgage is paid off, you have somewhere to live with very little ongoing costs. Retiring with a home means that even modest retirement savings or a pension can go a very long way when compared to someone who will need to stretch those payments to cover rent. If a homeowner is running low on cash in retirement, it could be as simple as downsizing their family home, a luxury not possible for someone who hasn't paid off their home or doesn't own one at all. Now, let's be generous and take this median age of 34 to buy a first home, stick a 30-year mortgage on top of it, and suddenly, even this generous assumption of a regular young worker is in their mid-60s still paying off a home loan. And this is assuming that this person never upgrades their home or renovates or does anything to increase their mortgage from the original one they took out over 30 years. The particularly morbid amongst you might think, well, the boomers have to die and leave us their homes eventually, right? And, well, yeah, I guess so. As unpleasant as that may be, it is a reality. The problem though is that this will likely only exacerbate the issue. We saw this in our video on why family fortunes disappear. Inheritances that could actually fund a retirement tend to go to people that are already pretty old and wealthy themselves. Now, again, the unaffordable housing issue is a debate as old as modern capitalism. But maybe this isn't an issue anyway. Maybe you are still unconcerned because you have plans to fund your retirement even without a house to call your own. Well, okay, let's put those plans to the test. The stock market is the other major vehicle by which people fund their retirement. Even fixed income pensions ultimately rely on the growth of these markets to provide incomes to their members in retirement. But this assumption of endless returns may be under threat. To understand why, let's consider a simple example. 10 lumberjacks are working at a sawmill that creates frames for residential homes. At the moment, the lumberjacks are only using basic hand tools, but if they all work hard and nobody slacks off, they will meet their quotas. One particularly astute lumberjack takes a portion of his paycheck and over time uses it to fund research into motorized tools. His money was well spent because he eventually invents the table saw. He then saves up a bit more of his money to buy the materials needed to build 9 copies of his new contraption. He then gives these 9 table saws to his colleagues who had previously been using those hand tools. This boosts their productivity enough that they can still meet their quota even if the first lumberjack doesn't show up to work at all. This is what we call capital investment, and it's how, at least in theory, we can sustainably fund people's retirements. The same amount of frames are made, the other 9 lumberjacks don't need to work longer and harder, and the first lumberjack has been properly rewarded for his creation with a nice cushy retirement. Of course, this is a very crude example, but in reality, most people do the same thing just through the medium of the stock market. Companies raise money through an IPO or an add-on offering and then use that money to purchase capital equipment, which will allow their workers to effectively and efficiently produce goods and services for the economy. But let's go back to our oversimplified example. Problems start to arise when more of these lumberjacks get the same bright idea. One might invest into a forklift to make the work of 9 men possible with just 8. And then another might do the same with nail guns to make the work of the remaining 8 possible with just 7, and so on and so on. But every time this happens, it gets a fair bit harder to find that next thing. Eventually, you are going to need an almost fully automated production line, and even then, you are probably going to want at least one worker to oversee this operation. Every human you take out of the equation and replace with a piece of capital becomes more and more expensive, especially when compared to some other alternative investments. Let's say Lumberjack 5 will need to invest millions of dollars into a robotic arm in order to effectively retire while still ensuring the quota of the lumber mill is met. He might just say, "Fuck it. What I'll do instead is just buy a factory and require the remaining 4 workers to work an extra 10 hours a week to pick up my slack while I go and retire." Now, this guy sounds like an asshole, but just think. How many hours a week are you working in your job to just cover rent? This investment into non-productive assets, as in assets that don't actually assist in adding value, is a major hurdle. Now, the classic example of a non-productive asset is something like gold, bitcoins, Pokemon cards, and of course, real estate. Now, real estate is weird because unlike these other non-productive assets, it does produce income without needing to be sold, and it does this through rent. Investing into real estate has been a particularly attractive investment for a lot of people, which does 2 things. It increases the price of real estate, causing more of this issue we saw in the first part of this video, but it takes away from investments into the types of productive assets that can sustainably fund retirements. There is one other problem beyond this as well, the overinflation of all asset markets. Let's take a look at our original example of those table saws. They were machines that made cut up pieces of wood. Let's say they chop up 20 pieces each a day. Now, let's replace those table saws with shares. These are effectively machines for making money in the form of dividends. Let's say each share makes $20 a day. In both examples, the lumberjack would need to own 9 of each to be able to fund their retirement. 180 pieces of wood would replace their job at the lumber mill, and $180 a day would replace their income, so either works just fine. Now, counterintuitively, problems arise when those assets become more expensive. Most people think stocks getting more expensive is a good thing, and it is for the people that already own them. Imagine each share was trading for $10,000. Saving up $90,000 is a pretty tall order for a lumberjack on $180 per day, but it is certainly possible over a working career. Now, imagine those same shares were trading for $100,000 while still paying the same $20 daily dividend. If you already own those shares, you would be feeling great because your on-paper net worth has grown handsomely. But our lumberjack now has to buy $900,000 worth of shares to fund his retirement, which is just not realistically possible within his working career. Now, this might sound like a far-fetched example, but it isn't. It's exactly what's happening today. To see this, let's look at the price-to-earnings ratio of the S&P 500, a collection of the 500 largest public companies in America. Historically, it has hovered around a multiple of 15. This means that on average, the stock price is 15 times the company's net income. Today, that multiple is sitting just around 50, which is the second highest it's ever been in history, falling only behind late 2008, which, as you all know, was a time of widespread economic prosperity. In plain English, this means that people are going to either need to invest 3 times as much to fund their retirement, or rely on the next biggest idiot to buy their shares off them in retirement for 100 times PE multiple, 200 times multiple, 1,000 times multiple, which, by the way, certain investors are already doing for some stocks. Now, you might say, oh, well, shares aren't like table saws with fixed outputs. These dividends can and likely will increase in the future, right? And sure, that's almost guaranteed. But it's still unlikely that we will ever see widespread PE ratios under 20 again for 2 reasons. First, if a company does start paying out consistently high dividends relative to its market price, well then investors will buy it, which will push up the price, meaning that it won't be a great deal anymore. Market forces are a bitch. The second reason is a bit more complicated, but it's one that has some leading economists genuinely concerned. Robert J. Gordon is an American economist who published this paper with the National Bureau of Economic Research. Is the US economy growth over? Faltering innovation confronts the 6 headwinds. It's a fantastic paper that is surprisingly readable even to people without a strong economic background. But spoiler alert, Gordon basically argues that the past 200 years of innovation and economic growth were more of an exception rather than the rule that we should expect to continue indefinitely into the future. Limitless growth in a finite world? You do the maths. Gordon basically argues that this generation is the 5th lumberjack. All the easy innovations that drastically improve productivity have already been made, and even gradual improvements from here on out will either be very expensive or just rent-seeking in nature, working more to shift value around in new and creative ways more so than actually working to create any. If this rather bleak outlook wasn't good enough, Gordon argued that this would coincide with what he described as the 6 economic headwinds. These are forces that will act to slow growth in economies around the world for at least the next 100 years. These headwinds are the loss of the demographic dividend. Basically, the economy saw a huge boost when women started to move into the workforce between the 1960s and the 1990s. Now, most women in developed countries work a professional career similar to their male counterparts, but that's just the status quo now. We aren't ever going to be able to double the workforce again unless, well, we make people work later and later in their lives. The second headwind is the loss in educational attainment, particularly in the USA. Education is becoming more expensive, less comprehensive, and increasingly irrelevant to the requirements of the modern workforce. A 3-year degree simply does not mean as much as it did 50 years ago, not to an individual or the economy as a whole. The third headwind is rising inequality, a touchy subject at the best times, but Gordon was surprisingly pragmatic about his approach to this issue. The paper noted that incomes were, on average, increasing by around 1.3% per year, but that growth was heavily focused on the top 1%. The remaining 99% only saw income growth of around 0.75% year over year, not even enough to keep up with inflation. That means that if this trend continues, it will be inevitable that larger and larger pools of workers simply won't have the financial means to save for retirement. However, if you are in the top 1%, you can say, nah, your video title is wrong in the comment section below. The 5th headwind is energy and the environment. The growth of the past century was driven by fossil fuels, a cheap, easily transportable, incredibly efficient source of energy that could power everything from automobiles to jetliners. But of course, they are a finite resource that have come at a cost. This cost will now be paid by younger and younger generations, either in the form of environmental regulations that slow down industrial output, or from complete environmental collapse that will also slow down production. The final headwind is debt. Household debt, government debt, corporate debt, it's all been growing steadily over the years, and eventually this needs to be paid back. This is ultimately going to result in the requirement for more income or less spending. For the government, producing more income is easy, they just tax more. But for individuals and businesses, the only option they might have is spending less. If someone is already running on a tight budget, then those regular contributions to a retirement account might be what ends up getting sacrificed. Gordon did present a likely outcome to alleviate this sixth issue for all parties, and you might be able to guess what it is. Yup, push back the retirement ages. Now, if this has all been bleak for you and you still think that you are going to make millions overnight, then good for you. I will have to work harder at crushing your spirit the next time. But until then, go and watch this extended cut video next to find out how we keep turning the future into someone else's problem. And don't forget to like and subscribe to keep on learning how money works.